Welcome to Asset TV. I'm Jillian Kemmerer here at the Museum of American Finance in New York. We are standing in a slice of Wall Street history to talk about its future, which is FinTech. I'm joined by Dan Simon, the CEO of Vested. So Dan, before we get started, tell me a little bit about your involvement with this incredible space.
Sure. This is the Museum of American Finance. It's the only finance museum in America. It's a Smithsonian affiliate. Just to put it in some context for you, China has 21 finance museums. America has one, and this is it.
Are they as good as this one, though?
No, nothing is as good as this. And I've been to, because I'm a huge nerd, like quite a lot of finance museums around the world. I was at the Bank of England Finance Museum, and it's nowhere near as good as this. So this is 48 Wall Street. If you are in town, please come and visit. There's my little plug. And really, it's a space that celebrates and records the important role that finance plays in the building and growing of America. And it's obviously finance has been a huge part of this country all the way back to Alexander Hamilton, who's of course very popular right now. He is the patron saint of the museum, and of course, his plan to assume state debt and create a national bank is really what kicks off, the financial industry. And so this is the only space in America that really celebrates that.
Okay, so let's talk about three of the headlines that might define the financial future, and we'll start with the first one. It's about robo-racketeering. I feel like with every new fintech innovation, there's a new litigation to go with it. So what exactly is this, and who's in trouble for it now?
Yeah, well, so what's happened, just to put it in context, it's quite a complex story, but Morningstar has a robo-type product called Goalmaker, and a class action lawsuit was recently filed in a court in Chicago against Morningstar and Prudential. And what that claims is that this robo is not acting as you would expect a robo to act, in kind of an impartial, way, that actually it's funneling its users or it's funneling investors to a highly overpriced product by Prudential. And so it's claiming that Morningstar and Prudential are basically in cahoots to rip investors off. And I think the broader context here is about the shine going off the penny of robos a little bit, right? There was a period of time when they were the hot new thing. Now, hands are so hot right now, robos. Now everyone's got a robo, and they're maturing. And as we sort of cross that chasm into more mass adoption, the honeymoon period is over. People are asking questions about robos.
And it feels like there's just a general mistrust of robos on behalf of the wealth management population that thinks that they're going to be eclipsed out potentially by the technology too.
Well, there's that. So there's the idea that advisors aren't, necessarily the first to adopt robos because they're worried about it, disintermediating them with their clients. The other challenges, I think, ING recently did a survey of 15,000 people. 2/3 of them were actually still quite skeptical about robos. There's, I think, a broader concern about automation, right? I read an article this morning. Would you fly in a plane without a pilot, right? So, driverless cars, if you read these stories about, Tesla's programming the car to kill you in certain circumstances, right? People are nervous about automation. There's always that resistance.
Potential for your portfolio to get killed by this.
And then there's the other concern on the flip side, which is, are they truly automated, or are there kind of humans behind it, right? So you see this with the Prudential and the Morningstar story. Back last year when Brexit happened, Betterment got a huge amount of trouble for halting trading, right? And so I think, it's betwixt and between. On the one hand, people are concerned about too much automation. On the other hand, are they truly automated, or is there sort of an insidious human behind the curtain, like in a Wizard of Oz style, who's actually pulling the strings? And there's that concern too.
Well, let's talk about some ways that those insidious humans might actually be helped with the rise of fintech. And one of those areas that's become really interesting is that custodians are increasingly leading the charge with fintech. Tell us more about that.
Yeah, so the big four custodians, right, Pershing and Fidelity and Schwab and the others, are, I think they've felt a little bit behind in terms of the fintech movement. They're traditionally kind of a back office kind of a function, really. And so they really are just sort of wanting a little bit of the pizzazz of fintech. So there's been a flurry of announcements about the acquisitions they're making, about new products that they're rolling out. And some of those are more what you and I would consider to be fintech, so chatbots, AI, helping advisors. But a lot of it's about workflow and e-authorization and the stuff that you and I would think of as considerably back office still, right? And I think this is a little bit of what I heard someone use the term the other day, innovation theater. So it's not really
brand building.
Yeah, a little bit. You know, if you're a big financial institution today, you've got to have an accelerator. You've got to have something called an innovation lab somewhere where you can take people. And, you know, is that really transforming your business, or is it a little bit of show and a little bit of sizzle for the steak? And the reality is also, you know, to read it in the papers, you would think that banks and financial institutions woke up and discovered technology about 2.5 years ago. The reality is, I've been working with financial institutions doing this kind of technology, making processing of transactions faster, trying to do authorization, security, this sort of thing for 15, 20 years. Financial services was one of the largest purchasers of technology outside of defense and aerospace, and has been for like 50 years. So,
but it sounds like in the case of these custodians too, by having the technology in-house, it eliminates going through that third party that would have to integrate with the custodian anyway, so could be more efficient?
Actually, some of them are changing that and actually partnering with a lot of things. So you actually see one of the things that's definitely happening, one of the trends that's definitely happening in FinTech is a move away from the not made here mentality, right? So I think for a long time, banks were resistant to partner with third parties. But actually, you know, if you look at Yodlee or you look at Plaid, you look at some of these other third-party providers, I think financial institutions are waking up to the potential of, look, we're not going to be able to build that ourselves. Why don't we just, create an ecosystem and plug in some of these third parties into it?
So let's shift our focus for our last headline globally, and let's talk a bit about Africa. There's always question among tech entrepreneurs in Africa of who's going to get the funding, but it sounds like FinTech has really been winning the race.
Yeah, FinTech's got a lot of funding. There's been 84% increase in African FinTechs getting funding over the last 2-3 years. There's a new payments provider called Flutterwave that just secured a $10 million round. And what's really interesting isn't so much the money, it's where that money is coming from. It's really the Sand Hill Road kind of Silicon Valley community that's stepping up and investing and seeing the opportunity in Africa. There's also just a huge number of FinTechs growing in Africa. Over the last 2 years, 50% of there's about 300 FinTechs right now in Africa, 50% have been created in the last 2 years. So there's a lot more for investors to kind of put money into over the last 18 to 24 months.
And it seems like in the US, FinTech is so much defined by disrupting something that's already there, whereas in Africa, perhaps it's filling gaps that don't exist where financial firms have left a hole.
That's 100% right. You look at the success of something like in Kenya, the M-Pesa, which is the transactional, almost the currency now that's running not on banking infrastructure but on telco infrastructure because the banks didn't exist.
Is it like a cryptocurrency?
No, it's just it's a payments platform effectively for two people to be able to wire money or credit to one another via not smartphones but really text old Nokia phones. So it really just runs on the telco platform. I think so. That's one thing, is that, you know, less to actually disrupt. They're not going head to head with existing banks. The other thing is just in the US, I think we're kind of running out of things for people to invest in, right? I sit on Barclays Techstars, I get pitched a lot of ideas, and lately those ideas aren't so much solving problems as kind of, you think, really, is there a market for this, right? Do I really need something that's going to get me the latte or whatever it is, right? So, it's the payments platform that also gives you a foot rub. I think that I wouldn't say we've solved the problems in the States, but we've certainly defined the problems across investments, remittances, payments, and there are products to solve those big problems, right? I think as investors are looking, the market is somewhat saturated here, whereas in Africa, you've got, it's greenfield opportunity, it's a blue ocean strategy. And then the last thing I'd say about it is demographically, it's a vast market and it's growing with lots and lots of people in it. So lots of opportunity. Huge opportunities there. Well, Dan, thanks so much for joining us, and thank you for tuning in. From the Museum of American Finance, I'm Jillian Kemmerer for Asset TV. Now, Dan, take me on a tour. I'm delighted to.